Hello everyone, we are Horizon Consultancy firm, and today we'll be presenting our 3-year financial analysis of First Quantum Minerals, commonly known as FQM, from 2021 to 2023. The purpose of this analysis is to provide advice to an investor seeking to invest 1,500,000 in FQM. Before we begin, we would like to state that this is a student project for Dr. Bryne's Kaulu's financial statement analysis course at the University of Zambia. The content presented is strictly for academic purposes and does not constitute financial advice. Our team members are Rosemary Muhango, Emmanuel Kapumba, Dennis Mlenga, Ketas Hamaimbo, and myself, Catherine Hasalama. Our presentation will cover 9 key sections: the company overview, executive snapshot, the profitability analysis, the interpretations, the solvency and liquidity analysis, the efficiency and activity ratios, the common size analysis, the key trends in operating, investing, and financing cash flows, recommendations, and investment decisions. We now move to the company overview. According to the Global Reach, First Quantum is a top 10 copper producer operating across Africa, Europe, Latin America, and Australia. FQM produces copper in concentrate, cathode, and anode form with gold, nickel, zinc, cobalt, and silver as additional outputs. In Zambia, FQM has 3 major operations: Consultancy Mines, which holds about 80%, with the remaining 20% by Zambia Consolidated Copper Mines Investment. It's located near Solwezi and is Africa's largest copper producer by volume. The other is the Sentinel Mines, which started full production in 2016, producing about 300 tons annually. The Enterprise Nickel project was aimed at boosting nickel output and contributing to diversification. In 2022, under the Investment and Development Project, First Quantum approved about $1.25 billion expansion at Consultancy Mines and invested in 100 megawatt solar plants in Chisamba to improve operational stability and reduce emissions. Currently, First Quantum is also negotiating a deal worth up to $2 billion with the Saudi Arabia Manara to sell a minority stake in its Zambian and nickel assets. Moving on to the executive snapshot to look at First Quantum's financial performance. Now see that revenue fell from about 7,626 million in 2022 to 6,456 million in 2023, showing a 15% decrease after growing from 7,212 million in 2021. We see that the operating profits also swung down sharply to 78 million in 2023 from 2,241 million in 2022 and 2,598 million in 2021. The earnings per share also turned negative in 2023, showing a loss of about 1.38 per share compared to the one in 2022 of about 1.5. Balance sheet in 2023, total assets amounted to 23,758 million, while total equity was 10,778 million, and total debt amounted to 7,379 million, which is current and non-current debt, which is prior to the years of 2021 and 2023. We can clearly see that 2023, the profitability declined and the earnings also highlight that 2023 was a difficult year for the company. Looking at First Quantum's cash generation, we see that the net cash from operating activities was 1,427 million in 2023, and it decreased from 2,332 million in 2022. We'll talk more about the cash generation when we look at the cash flow statements. Moving on to the profitability analysis, we're going to look at the return on equity using the DuPont analysis and the margin ratios. The profitability ratios are financial metrics used by analysts to measure and evaluate the ability of a company to generate income relative to revenue, assets, operating costs, and shareholders' equity during a specific period. The return on equity measures the company's profitability from the shareholder's perspective. Using the DuPont analysis, we break it down into the profit margin, the asset turnover, and the financial leverage. At the return on equity, in 2021, it was about 9.47%. Slightly up in 2022 of about 9.48%, but it turned negative in 2023, meaning that First Quantum destroyed shareholders' value. The net profit margin was around 15% in 2021 and 2022, but dropped to negative 19% in 2023. Looking at the gross profit margin, It fell from 35.5% in 2021 to 28.8% in 2022 and further down to 20% in 2023. Looking at the operating margin, in 2021 they decreased drastically from 36% in 2021 to just 1.2% in 2023. This shows that the company's ability to generate profit decreased sharply in 2023. Interpretations. This slide shows you the interpretations of the return on equity that were explained in the previous slide. Looking at the margin ratios, the net profit margin, the gross profit margin, and the operating margin, we see that they all showed a decreasing trend from 2021 to 2023, clearly showing that the company's ability to generate profit decreased sharply in 2023. Furthermore, from these results, we can observe a clear trend. First Quantum was highly profitable in 2021 and 2022, with strong returns and healthy margins. However, in 2023, profits collapsed due to raising production costs, weaker copper prices, and operational disruptions. This shift raises concerns about the company's ability to sustain profitability moving forward. So now my colleague Rosemary Mhango will take you through the liquidity and solvency ratios, the efficiency and activity ratios, as well as the common size analysis.
Hello everyone, my name is Rosemary Muhango and I'll begin with the liquidity and solvency ratio analysis. These ratios are important because they measure the company's ability to meet its short-term obligations as well as its long-term financial stability. The first liquidity ratio here is the current ratio. In 2021, the current ratio was 2.34. It slightly improved to 2.40 in 2022, before tightening to 1.72 in 2023. This shows that while the company's liquidity remained above 1, it significantly reduced in 2023, indicating lower short-term flexibility. The quick ratio remained stable at 1.56 both in 2021 and 2022, but dropped sharply to 0.93 in 2023, which indicates that FQM's near cash assets may not be enough to meet short-term obligations. For the cash ratio, it moved from 1.19 in 2021 down to 1.04 in 2022 and further to just 0.64 in 2023, which shows a weak ability to rely on cash reserves to meet obligations. Moving on to the solvency ratios. From 2021 to 2023, the company's long-term debt to equity ratio declined from 0.66 to 0.56 before rising again to 0.61 in 2023. Which indicates a moderate reliance on long-term financing compared to equity. For the financial leverage, it fell from 2.30 in 2021 to 2.21 in 2022 and remained almost unchanged in 2023. This suggests that the company reduced its reliance on debt financing relative to equity. In summary, the company showed relatively stable liquidity and solvency in 2021 and 2022, but 2023 reflects a tightening liquidity position. This slide shows the summary of the liquidity interpretations that have already been discussed. And this one shows the summary of the solvency interpretations which have also already been discussed. Okay, we can now look at the efficiency and the activity ratios. Table shows that the total assets turnover improved in 2022, showing a better assets management, but then it dropped in 2023, which signals a deterioration in efficiency. For the inventory turnover, it improved in 2022, suggesting inventory management improvement, but again it weakened in 2023. Moving on to the payables turnover, First Quantum's accelerated its payment in 2022, reducing reliance on credit supplies. But then it extended its payment period in 2023, improving liquidity. For the receivables turnover, FQM's receivables turnover ratio has been falling steadily. This signals declining efficiency in credits and collection management, as customers are taking long to settle their balances. For the fixed assets turnover, FQM's ability to convert fixed assets investment into sales improved slightly in 2022, but weakened in 2023, ending by below the 2021 level. This points to reduced efficiency in fixed assets management. For the working capital turnover, the trend shows strong efficiency in 2021, followed by a significant drop in 2022, with only margin recovery in 2023. This suggests that FQM's management of working capital has weakened overall. Here are the interpretations of the efficiency and activity ratios that were just from discussing. Moving on to the common size analysis. We start with the common size income statement. The graph here just shows a snapshot of the common size income statement with only a few key elements: sales, cost of sales, and operating profits. From 2021 to 2023, the cost of sales has been steadily increasing, rising from 64.5% in 2021 to 80% in 2023. This significant rise has gradually eroded profitability. Operating profit fell sharply from 36% in 2021 to just 1.2% in 2023. This trend highlights growing cost pressure and narrowing profit margin. If no corrective measures are put in place, the company risks slipping into operating losses. Moving on to the common size balance sheet, the first graph here summarizes FQM's total assets, total liabilities, and total equity, which can actually help us depict its solvency. In 2021, liabilities were slightly higher than half of total assets at 54.5%, while equity stood at 45.5%, showing a moderate solvency position. By 2022, solvency improved, with liability decreasing to 41.2% and equity rising to 48.8%, meaning that the company was relying more on equity financing. However, in 2023, solvency weakened again. Liabilities increased to 54.6% and equity fell to 45.4%, signaling increased leverage and heavier reliance on debt financing. Yeah. The second graph here summarizes FQM's total current assets and total current liabilities, which can actually help us depict its liquidity. In 2021, current assets made up 15.6% of total assets against liabilities of 6.6%. This showed a comfortable liquidity cushion. In 2022, liquidity improved slightly with current assets at 16.6 compared to liabilities at 6.9%. But in 2022, the situation reversed. Current assets fell to 14.6%, while current liabilities rose to 8.4%, narrowing the gap. This shows reduced short-term financial flexibility and growing pressures of liquidity. Now moving on to the key trends in operating, investing, and financing cash flows. The table here summarizes FQM's operating, investing, and financing cash flows from 2021 to 2023. FQM's operating cash flows has been decreasing from 2021, 2022 to 2023. And its investment cash flows are in brackets showing that these were outflows, and the outflows have been significantly increasing from 2021, 2022 to 2023, indicating ongoing capital expenditure. FQM's financing cash flows were also negative, which signals that these were outflows. From 2021 to 2022, the financing cash flows increased but dropped significantly in 2023. This outflows shows that the company is paying back obligations more than it's raising its funds. This slide shows a summary of the trends in FQM's operating cash flows. This one shows its trends in the investing cash flows. And this one shows the trends in the financing cash flows. On to the common size cash flow analysis. The graph here represents a summary of the common size cash flow statement, with a blue line indicating net cash flows from operating activities, the orange line representing net cash flows from investing activities, and the gray line here representing the net cash flows from financing activities, all of them expressed as a percentage of sales revenue. Net cash from operating activity has weakened consistently, falling from 40% in 2021 to 30.6% in 2022 and down further to 22.1% in 2023. This reflects declining efficiency in generating cash from the core business activities. Investing activities remained stable around 15% in 2021 and 2022 before rising sharply to 21.4% in 2023, reflecting heavier capital investment. And the financing activities shows volatility with outflows increasing from 11.7% in 2021 to 17.5% in 2022, then easing to 12% in 2023. Finally, looking at free cash flows. This is what's left for investors after covering all expenses and reinvestments. Free cash flows to the firm is what's available to both debt and equity holders, while free cash flows to equity is what shareholders can actually receive. But because of the decline in operating cash inflows and higher investment outflows, free cash flow has been under pressure. As it can be seen from the table, both free cash flows to firm and free cash flows to equity have been reducing from 2021 to 2022. This leaves less room for both debt servicing and shareholders' returns. I will now hand it back to my colleague Catherine Hasalama, who will talk about the final recommendation.
Hey, I'm back to give the final recommendation based on our findings. Our recommendation is that the investor should hold until operational recovery is visible. Based on First Quantum's performance in Zambia over 2021 to 2023, our advice is that the investor should not invest at this time. The reason we're telling you not to invest at this time is, while First Quantum performed strongly in 2021 and 2022, with healthy profitability and stable liquidity from its Zambian operations, 2023 saw a sharp deterioration in performance, including profitability collapse and weakened liquidity. Until earning recovery is demonstrated, investing would carry above average risk. Thank you so much for watching our videos. Please subscribe to watch more of our videos as Horizon Consultancy Firm.